When you're consolidating financials, you're consolidating multiple entities into one economic entity. You're going to combine some items and you're going to eliminate some items. We are going to be talking about consolidated financial statements, which at its simplest form is combining two or more entities into one economic entity. Now, you're going to do this when there's this concept of control, and we're also going to go over this concept of power in this video. And we're going to be hitting ASC 810, the codification related to consolidating financial statements. This is the GAAP codification. We're going to go through what gets combined, what gets eliminated. We're going to go through the two different models, the voting model versus the variable interest model. And then we're going to dive a little deeper into VIEs, which is variable interest entities. This is also going to be at least a 4-parter, maybe a 5-parter related to consolidation accounting. This is part 1, so stay tuned. When you're consolidating financials, you're consolidating multiple entities into one economic entity. You're going to combine some items and you're going to eliminate some items. So let's start with combine. Combine, you want to combine all the revenues, you want to combine all the expenses, you want to combine all the assets, and you want to combine all the liabilities. You notice I stopped at equity. Equity is going to look like the parent's equity. So let's dive into the elimination. So you want to eliminate any intercompany activity. This will be due tos, due froms. So if you have an intercompany receivable and an intercompany payable between the parent and subsidiary, you're going to eliminate those two in consolidation. Same with any sales or purchases if there's any inventory or intercompany transactions happening. So if the parent is buying stuff from the subsidiary and the subsidiary is selling it to the parent, you're going to eliminate that activity because you don't want the double counting to be reflected in your financials. Also, you're going to eliminate any dividends. Let's say a subsidiary dividend up to the parent. Those transactions are going to be eliminated in consolidation. Also related to the equity, why you don't roll up the equity is the parent has an investment in subsidiary on its books, which is going to equal the subsidiary's equity. And when you combine those two in consolidated financial statements, they get eliminated. You eliminate the subsidiary's equity, and the parent eliminates the investment in the sub. That's why you don't see equity combined like revenue, expenses, assets, and liabilities. Look for part 2 of this series to dive deeper into eliminations. I'm going to keep it surface level here. ASC 810 has 2 models that you look at to see if you consolidate an entity or not. One is the voting model, which for the most part is pretty straightforward. For corporations, if a parent owns more than 50% of a corporation, more than likely they're going to consolidate that entity into their results. With partnerships and limited liability companies, you need to look a little further down. That 50% level might not be enough. More than likely it's probably gonna be, but you wanna look and see, is there any kick-out rights, or is there any member or partner that has voting rights over just the ownership. The variable interest model is more concerned with who has the power of decision-making for that entity. Is it the parent? Is it the entity itself? Or is it another factor? If you can determine that it's the parent, more than likely you're going to come to the conclusion that you're consolidating that entity. This is where you have that qualitative assessment to look at these VIEs, these variable interest entities, to determine whether you need to consolidate that entity or not. Because on the surface level, it does not look like an entity that should be consolidated. There's no controlling financial interest from an equity standpoint. But there might be contractual. There might be owners of the entity and the parent have similar ownership. You want to look at who has the power to make decisions. That's the most important factor when you're considering the variable interest model. With the variable interest model, you have 9 exceptions to take into consideration. Some are new, some have been there. I'm not going to go through the details of these because there's a lot to take into consideration for these scope exceptions, but let's just name the 9 that we have here in ASC 810. So 1 would be the employee benefit plan, 2, government organizations, 3, there's certain investment companies, 4 money market funds, 5 non-for-profits, 6 separate accounts of life insurance reporting entities, 7 if there's a lack of information, it's basically you just don't have enough information to make a judgment call, 8 there's a business scope exception, and 9, this is fairly new, the private company accounting alternative. Those are 9 scope exceptions, and they all have their own rules and nuances with them. Here are 3 characteristics of a VIE that might result in that entity being consolidated into the parent. 1, the parent has decision-making or governing control over the entity, even though they don't have the ownership. That might result in that VIE getting consolidated. Another is if that entity incurs losses, then that parent has to absorb those losses. Basically, it's funding the entity, even though it doesn't look like it has the controlling ownership of that entity. A third example is the parent has the right to receive residual income. Basically, they have a preferred benefit from this entity, even though it doesn't look like they have the controlling ownership of that entity. That is a consideration related to consolidating a VIE. So here are some questions you want to ask when you're assessing whether you have a variable interest entity that needs to be consolidated. Why was this entity created? What is the purpose of the entity that you want to examine the design or redesign of any entities that could be considered a variable interest entity. What are the terms of the contracts between the entities? Who has interest in both those entities? Are there similar investors on both sides? What do the governing documents of the entity say? What do the formation documents say? Those are some examples and some areas that you want to look at to consider if you have a variable interest entity. Next step within this consolidation video series, we're going to go through how to combine entities together and how to eliminate transactions between the entities so you get a full set of consolidated financials. All right, have a good rest of the day. Take care. Goodbye.